Imagine I hand you $25 right now and tell you that this tiny amount could eventually help build a portfolio worth more than $600,000 and potentially create more than $4,800 a month in dividend income. Your first reaction might be to laugh. $25 is dinner. It is a couple of coffees. It is a subscription you forgot to cancel. It is parking, takeout, or one small impulse purchase that disappears from your checking account before you even notice. But that is exactly why this story matters. Because the difference between a person who builds wealth and a person who keeps wondering where their money went is often not one giant financial decision. It is one tiny decision repeated long enough for compound interest to take over. And there is a catch. If you only look at what $25 can buy today, it looks almost meaningless. If you look at what $25 can become over decades, you're looking at something completely different. Today, I want to show you the math behind that transformation. How inflation quietly attacks your paycheck while assets keep moving, why dollar cost averaging works even when markets are uncomfortable, and how a simple diversified fidelity index fund portfolio can turn consistency into a serious wealth building machine. Stay with me because near the end, we're going to put the entire strategy on one scoreboard and compare what happens at year 10, year 20, and year 30. That final number is where the $25 habit stops looking small. And before we get into it, this is David Marshall Finance. I break down money concepts in plain English without the Wall Street theater. Subscribe now because the goal on this channel is simple. Make money easier to understand so you can make better decisions with it. Now let us start with the strangest part of this entire idea. $25 feels small because your brain is built to think in straight lines. You give $25 today, you imagine having roughly $25 more invested tomorrow. Then another $25, then another. It feels like adding coins to a jar. This is what behavioral finance calls a linear bias. Your brain assumes that small inputs create small outcomes, but investing does not behave like a jar. It behaves more like a snowball rolling downhill. At first, the snowball is almost invisible. Then the snowball gets large enough that the snowball itself starts collecting more snow. That is compound interest. Your money earns a return. Then the return has an opportunity to earn a return. The process starts slowly, which is exactly why people underestimate it. They are watching the first few years and judging the entire movie from the opening scene. Think about your own spending for a second. $25 can disappear in 10 minutes, but $25 invested every week can become a habit that keeps working while you sleep, while you work, while you take vacations, and even while you are not thinking about money at all. That is the first mindset shift. We are not trying to become rich because $25 is powerful by itself. We are trying to become financially powerful because consistency over size changes the equation. And that brings us to the real opponent. It is not laziness. It is not even a stock market crash. It is purchasing power. Look at your life over the last few years. Housing costs moved. Transportation costs moved. Food costs moved. Insurance moved. Utilities moved. The things you have to buy kept getting more expensive whether you felt financially ready or not. The blueprint for this strategy assumes 2025 inflation around 2.7%, while wage growth sits closer to 3.5% to 4%. At first glance, that sounds like wages are winning. But averages hide the pressure. Essential costs can rise faster. Housing can run around 4%, transportation can rise around 5%, and if the expenses you cannot easily cut are rising faster than your paycheck, your purchasing power can still shrink even while your salary goes up. That is paycheck erosion. You get a raise and somehow still feel broke. You are not imagining it. This is where wage growth versus asset growth becomes important. Your paycheck usually grows in steps. Your expenses can jump. Your investment portfolio, however, has the potential to grow in a different way. It can capture price appreciation, dividends, and compound interest. The problem is that most people spend almost all their attention defending their current lifestyle while barely protecting their future purchasing power. They treat investing as what happens after everything else gets paid. The result is simple. Voluntary spending gets protected and future wealth gets whatever is left. Reverse that. Pay yourself first. Create the investment habit first. Then let your lifestyle adapt to what remains. This is one reason the phrase consistency over size matters so much. You do not need an impressive starting amount. You need a repeatable system. And here is the second curiosity loop. What happens when we take a contribution so small that it barely changes your weekly budget and allow time to do the heavy lifting? We can test it with an even smaller number than $25. Imagine investing $10 a week and earning a 10% annual return over time. In year 1, the account is around $572. In year 2, it grows to about $1,210. In year 3, about $1,893. Notice what is happening. You are still adding only $10 a week, but the account is beginning to work alongside you. The first year feels like your money is doing almost nothing. The third year feels different. By year 5, the compounding effect becomes more visible. By year 10, the gap between total contributions and account value starts to get interesting, and by year 20, the growth can become the dominant force. This is the snowball effect, but there is a psychological trap here. During those early years, the scoreboard can make you feel like you are failing. If you invest $25 this week and your portfolio falls $25 next week because the market drops, your brain sees failure. It says, I put money in and I lost money. That is loss aversion. A loss feels more painful than an equivalent gain feels exciting, so investors stop. But stopping during uncomfortable periods is often exactly what destroys the long-term process. Dollar cost averaging changes the question. You are not asking the market for permission to invest. You are investing on a schedule. When prices are high, your $25 buys fewer shares. When prices are low, your $25 buys more shares. You keep accumulating. And that is why the new scoreboard should not be, how much did my portfolio grow this week? The better scoreboard is, did I invest this week? Did I invest this week? That question is boring. That is precisely why it is powerful. It shifts your attention from something you cannot control to something you can control. The stock market will rise, the stock market will fall, headlines will scream, recessions will appear, people will predict crashes, people will predict booms. Your job is not to become a perfect forecaster. Your job is to keep executing the plan. Now let us zoom out, because this is where history becomes useful. Over roughly the last 100 years, the broad stock market has demonstrated a powerful long-term upward trend, with long-run average returns often discussed around 12% before accounting for fees and taxes. But the path has never been smooth. Wars happened, banking crises happened, recessions happened, market crashes happened, inflation happened, entire industries disappeared, yet diversified ownership of productive companies kept finding a way to recover and grow over long periods. This does not mean stocks always go up. They do not. It does not mean a 12% return is guaranteed. It is not. Historical averages are not promises, they are context. The real point is resilience. A diversified portfolio is designed to survive the fact that you cannot predict which company, sector, or decade will dominate next. That is why index funds matter. An index fund is a basket. Instead of trying to identify the one winning stock, you own many businesses through one investment. That reduces the danger of relying on a single company. It also fits the psychology of someone who wants a system rather than a full-time trading hobby. Imagine checking your account after a brutal market week. Your portfolio is down, your news feed is filled with panic, your coworker says they sold everything, your cousin tells you the economy is finished. You have two choices. You can turn a temporary decline into a permanent decision, or you can remember what the strategy is actually built to do. Keep buying, keep diversifying. Keep the time horizon long. That is consistency over size. It is also why the early years are emotionally harder than the later years. At the beginning, your deposits are doing most of the work. Later, the portfolio starts doing more of the work. That transition is one of the most important moments in wealth building, because the investor suddenly realizes something. Their habit has become an asset. Now we need to talk about selection. You cannot just throw money into any fund and call it diversification. We want to think about diversification, sector exposure, dividend growth, historical resilience, and low expense ratios. Expense ratio matters because fees create a drag on long-term compounding. The fund's net asset value matters because it reflects the value of the holdings inside the fund. Dividend yield matters because it tells us the income being generated relative to price. Dividend growth rate matters because rising distributions can become significant over decades. And price appreciation matters because dividends are only one part of total return. The objective is not to find the fund with the biggest dividend today. A huge yield can sometimes be a warning sign rather than a gift. We want a structure that can balance growth, income, and diversification. So let us build an equal-weighted portfolio model using the specific fidelity funds in our framework. The first fund is FZROX with a 1.01% dividend yield, 7.19% dividend growth, and 14.06% price appreciation. The second is FITLX with a 1.1% dividend yield, 15.42% dividend growth, and 13.92% price appreciation. The third is FGRIX with a 1.04% dividend yield, 27.47% dividend growth, and 10.46% price appreciation. The fourth is FDGFX with a 1.24% dividend yield, 22.81% dividend growth, and 5.08% price appreciation. The fifth is FSGX with a 2.52% dividend yield, 15.15% dividend growth, and 7.62% price appreciation. These are not magic tickets. They are components in a portfolio model. The important idea is that each fund brings a different mix of exposure, yield, growth characteristics, and market behavior. In an equal-weighted portfolio, we are not betting everything on one sleeve. We are creating a basket and letting the combined structure do the work. Now watch what happens when we use simple average metrics across the 5 funds. The average dividend yield comes to 1.38%. The average dividend growth rate comes to 17.61%. The average price appreciation comes to 10.23%. Those numbers are not a forecast and they do not guarantee future performance. They are a simple way to understand the model, but they help us see why focusing only on today's dividend yield can be misleading. A 1.38% starting yield may not sound exciting, but a 17.61% dividend growth rate in the historical framework changes the picture. The income stream is not just about where it starts, it is about how it can grow, and this is where many investors make another mistake. They search for passive income as though passive income must start large, but passive income can start tiny. The first dividend payment might be a few dollars, then $10, then $50, then a few hundred. The psychological breakthrough happens when you stop asking whether the income is impressive and start asking whether it is growing without requiring another hour of labor. That is the beginning of financial independence. Now we can finally build the scoreboard you were promised. Start with a $25 weekly contribution and a long-time horizon. At year 10, the portfolio model projects around $23,000 in value and roughly $500 in annual dividends. $500 a year is not going to replace a salary. That is not the point. The point is that your habit has created a real financial asset. You can see it, you can measure it, it exists because you kept investing. Then the curve gets more interesting. By year 20, the projection reaches around $113,000 in value and about $5,000 in annual dividends. Now the income is starting to feel real. $5,000 is several months of utility bills. It can cover part of a mortgage payment, it can fund a vacation, it can help with healthcare costs. More importantly, it is being generated by an asset rather than an additional shift at work. And then we reach year 30. The projection is around $641,000 and approximately $57,600 in annual dividends, which is about $4,800 a month. Stop there for a second. This is the moment the entire strategy was designed around. $25 a week did not become powerful because $25 is a lot. It became powerful because consistency over size allowed time, compound interest, price appreciation, and dividend growth to work together. That is the snowball effect. But there is something even more important than the number. Your behavior has changed. You are no longer the person trying to find a perfect time to invest. You are the person who invests every week. You are no longer measuring your financial life only by your salary. You are measuring wage growth versus asset growth. You are no longer thinking only about what your paycheck can buy this month. You are building an asset that may help protect purchasing power decades from now. This is also where tax strategy enters the conversation. The same investment can have different results depending on the account you use. Tax drag can reduce the amount that compounds in a taxable account. Pre-tax deductions can affect how much income is exposed to taxes today. Retirement accounts can change the timing of taxation. Your personal situation matters, and this is where individualized tax advice can become important. But the broad principle is simple. Do not focus only on the headline return. Think about what you keep after taxes, fees, and inflation. A 10% return that gets heavily reduced by tax drag and expenses is not the same as a 10% return you keep compounding efficiently. That is why expense ratio matters. That is why account type matters. That is why net asset value matters. The details matter because time amplifies everything, including friction. There is another behavioral finance trap called status quo bias. People stay with whatever system already exists because changing it feels uncomfortable. They keep the same spending habits. They keep delaying investing. They keep saying they will start after the next raise, after the next bonus, after the house is paid, after the kids are older, after the economy gets better. But the market does not send you an invitation when conditions become perfect. Perfect conditions are usually visible only in hindsight. The person who waits for certainty is often waiting for a moment that never arrives. The person who builds a small automatic habit does not need certainty. They need repetition. That is why I want you to remember one phrase. Did I invest this week? Not did the market go up. Not did my portfolio beat the S&P 500 this week. Not did I pick the perfect fund. Did I invest this week? That question can survive a bad headline. It can survive a recession. It can survive a market crash. It can survive a boring Tuesday. A financial system that works on boring Tuesdays is a system worth respecting. Now imagine two people who earn similar salaries. Tyler sees $25 as spending money. Jahan sees $25 as a seed. Tyler spends the money and gets something immediately. Jahan buys ownership and waits. 10 years later, Tyler may have thousands of small purchases that are almost impossible to remember. Jahan has a visible asset. 20 years later, the gap becomes larger. 30 years later, the original decision can look almost absurdly small compared with the outcome. This is why wealth often looks slow before it looks obvious. People notice the destination and forget the repetitive decisions that created it. They see the $600,000 portfolio. They do not see the thousands of times someone chose the future over a tiny impulse. That is the hidden power of consistency, and there is one more twist. $25 is not necessarily the final number. It can be the training ground. Once the habit feels normal, you may increase the contribution. 25 becomes 35, 35 becomes 50, 50 becomes 100. The strategy scales because the behavior scales. The amount changes, but the operating system stays the same. Automate the contribution, diversify the portfolio, keep your time horizon long, reinvest when appropriate, review the plan periodically, control your expenses, avoid emotional decisions, and keep asking, did I invest this week? That is the operating system. The market provides the environment. Your behavior provides the consistency. Time provides the compounding. Now let us test the strategy against reality. What happens when markets crash? The portfolio value falls. That part is real. What happens when inflation spikes? Purchasing power falls. Also real. What happens when your expenses jump because your car breaks or your rent increases? Your budget gets tighter. Also real. The goal was never to make those problems disappear. The goal is to build a financial asset that can eventually stand beside your paycheck and reduce your dependence on a single source of income. This is the deeper meaning of passive income. It is not free money. It is income generated by capital you already own. And when that capital grows, the income potential can grow with it. That is why dividend growth matters. That is why price appreciation matters. That is why diversification matters. That is why the portfolio is built from multiple funds instead of one big bet. You are not trying to predict the future. You are trying to participate in it. There is also a retirement implication. Many people think retirement is a date. It is not. Financial independence is a ratio. It is the relationship between what you need and what your assets can provide. If your expenses are high, you need more assets. If you can keep expenses reasonable, the target becomes more achievable. A growing portfolio can create options. Maybe you retire earlier, maybe you work fewer hours, maybe you change careers without panic, maybe you help your children, maybe you simply stop worrying every time the market drops because you know your system is designed for decades, not days. That is the freedom most people actually want, not a sports car, not a penthouse. The ability to say no. And here is the documentary-style truth about the entire strategy. The most important number may not be $641,000. It may be 25. Because 25 is where the story starts. It is the amount small enough to dismiss, small enough to underestimate, small enough to spend without remembering. But when you repeat it for years, the number stops representing $25. It starts representing a system. A system that says I'm willing to exchange a little convenience today for more freedom later. A system that recognizes inflation is happening whether I pay attention or not. A system that uses dollar cost averaging instead of prediction. A system that uses index funds instead of stock picking. A system that values consistency over size. A system that measures success by behavior. Did I invest this week? That is the question. And when the market falls, the answer can still be yes. When the news is scary, the answer can still be yes. When the portfolio feels too small, the answer can still be yes. When the economy is uncertain, the answer can still be yes. That is how a tiny habit survives long enough for the curve to matter. So let us close with the scoreboard one more time. Year 10, around $23,000 and about $500 in annual dividends. Year 20, around $113,000 and roughly $5,000 in annual dividends. Year 30, around $641,000 and roughly $4,800 a month in dividends based on the model. The exact future will be different. Returns will change. Dividends will change. Markets will change. Inflation will change. Taxes will change. Your contribution may change. But the underlying principle does not need to change. Start small, automate it, diversify, keep investing through cycles. Give compound interest time to work, protect your purchasing power, watch your fees, understand your taxes, and most importantly, stop judging a 30-year strategy by what happens in the first 30 days. The first year may feel boring, the second year may feel boring, even the fifth year may feel boring. Then one day you look at the scoreboard and realize the snowball is no longer small. That is the moment most people miss because they quit before it arrives. Do not make the mistake of thinking your small contribution is too small to matter. The question is not whether $25 can make you rich this month. It cannot. The question is whether $25 invested consistently can become the first brick in a financial system that compounds for decades. The math says it can become meaningful. The behavior determines whether you will actually get there. So the next time you are about to spend $25 on something you will barely remember, pause for 1 second and ask yourself, did I invest this week? because $25 can buy you something today. But $25 repeated over time can buy something much more valuable. Options, flexibility, financial independence, and eventually the ability to let your money work while you decide what you want your life to look like. This is David Marshall Finance. If this video helped you see small investing differently, subscribe to the channel. And remember the rule that can change the entire game: consistency over size. Did I invest this week?